Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jay Moore, founder and CEO of FX Hedgepool, a matching engine for the mid-market execution of FX swaps. It's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Good to be here.
All right, and Jay, the FX swap space growing at an astonishing rate, currently averaging $3.2 trillion per day. What's behind all this growth?
Yeah, I mean, the FX market is the largest market in the world. And, the swaps component of that is roughly half, driven largely because of the passive investments that, you and I invest in our portfolios every day and the growth of those assets and, the foreign nature of those assets and the need to hedge them. So they're hedged with swaps. And as a result, the growth is just continuing.
Are these growing liquidity needs supported by the current market structure?
Yeah, I mean, the problem with the market today is that there's this bottleneck of liquidity for investors, institutional investors, to source liquidity from the market in that they need to trade with banks. And the relatively few banks that trade FX is really who provide credit. And so there's this tangling of credit and liquidity that happened today. And therefore, there's this growing demand and need for banks to provide liquidity in the future. So, as the volumes continue to grow, there needs to be different and alternative ways for the buy side to source liquidity.
How do peer-to-peer networks help to promote liquidity and market quality while reducing risks for institutional investors?
Yeah, I mean, this is where, the idea of peer-to-peer is so important in that, where this bottleneck occurs and where the buy side is so dependent on the sell side for the banks for liquidity in the swaps, if there's a way that they can provide liquidity to each other as this sort of natural source of the trades themselves, large asset managers, one dollar-based hedging euros, and perhaps on the other side, a European-based manager hedging dollars, they have this natural need to find liquidity from each other. But again, they're dependent on banks, and they each go through banks who are going through brokers and through banks to ultimately find the other side of the trade. So if we can find the two natural sides of a trade in a peer-to-peer type of market, you can eliminate all of this need for, or all of these layers of cost and risk that exist today in the way the market is structured. So our goal is really to eliminate that and find a better path for those two endpoints to meet in a very safe and natural way.
So, Jay, what have been the primary challenges to peer-to-peer in the past?
Yeah, I think the biggest challenge for peer-to-peer in general is the fact that there's credit involved in these types of trades. And foreign exchange is a derivative, is an OTC market, right? So if a $billion swap needs to be executed in the market, it has to happen between two parties that ultimately have credit relationship with each other. And there's a trust there. And it's so, documented under things like ISDAs and whatnot. But ultimately, for a large manager to trade, they need to go to their limited panel of banks with whom they've got a credit relationship with. And so that credit relationship complicates matters, right? It makes it very difficult for two buy-side firms, two large asset managers, to trade with each other because they don't have a credit relationship. So for us, what we really sought to do was find a better way, rather than just doing something new and different and automating or electronifying the market the way that, things evolve naturally. We said, is there a way to kind of change things, transform it? Can we look at it in a completely different way and, change the market structure? And as such, we said, if we can decouple this sort of dependency between credit and liquidity, then liquidity can come from anywhere. Buy-side firms can provide liquidity safely to each other and think about credit in a different way. And so that credit limit has really kind of capped out and created, like I said earlier, the bottleneck where everything needs to go through, many on one side, going through a very few to get to many on the other. And so if we can bring the endpoints together by breaking that dependency between credit and liquidity, things can really open up in a much more efficient way. And that's what we've done at Hedgepool.
And what impact will the growth of peer-to-peer networks have on the overall relationship between the buy and sell side?
Yeah, I think, that when we started this, as any peer-to-peer network, would typically, think about is, well, the sell side's going to hate it, right? Because they think about disintermediation. But we said this is very different. This is much more about win-win, because what's happening is that credit as a service is now something that where a sell side firm can provide credit to the buy side without having to provide liquidity. So allow the buy side to get liquidity from peers, but still offer the ability to settle that trade and maintain the credit relationship. So all of a sudden now banks are not relied upon for providing liquidity to the OTC FX market, they're saying we can stand in the middle from a settlement perspective and offer you credit as a service. And especially now when more and more of these capital markets types of businesses are dependent on increasing revenues and volumes and margins while managing their risk, right? The market risk that's associated with these trades. Credit as a service is a much more dependable and sustainable, measurable, transparent service that they can offer to their clients while continuing to do the more sort of strategic trades that come along with, outside of the swaps market. So it's really creating a nice sort of win-win for the sell side and the buy side in what we've done.
So Jay, to wrap up here, when we think about it, $3.2 trillion daily, what does that mean for the everyday investor such as yourself and me?
Yeah, I think that 3.2 trillion is actually an inflated number because of the fact that liquidity is recycled through the market. You might have a manager trading with a bank who's trading with a broker who's trading with another bank who's trading ultimately with the offsetting trade with another buy-side firm, which is creating many layers or versions of this same trade going through the market, creating settlement risk, platform fees, costs, payment services, all sorts of different layers of cost that at the end of the day are coming out of our pockets as investors in these funds that these buy-side firms are managing on our behalf in our 401ks and our investment portfolios. So at the end of the day, the benefit is that it's removing all that cost and bettering the investment experience and the end outcome for all of us as day-to-day investors.
All right, Jay, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.